investments, mergers and acquisitions, joint ventures, and other strategic transactions. Please join me in welcoming Ori Solomon.
Thank you very much. Thank you. So we're just going to take the last hour of the day here, just nothing else between you and cocktails but this one panel, to go through some of the current trends in Wall Street on deals across the country and the world, and get some insights from really a panel that needs no introduction, but I'll ask each of them to just quickly introduce themselves. We'll start with Kim.
Good afternoon. My name is Kim Nearing. I am a venture partner with BDCF. BDCF is the first US dollar healthcare fund in China, founded in 2005 by two Harvard MD PhDs. LPs are the usual suspects: Morgan Stanley, Mayo Clinic, BlackRock, etc. And according to the Kellogg Foundation, one of our LPs, we're one of the top 3 performing funds, healthcare funds in China. Nice to meet you.
Hello everyone. Andrew Gickin. I'm a managing director and co-head of healthcare U.S. banking at Raymond James, and happy to be here again, second year doing the panel. I'm looking forward to today's discussion.
Can you hear me? Perfect. Hi, Jeff Meyerson, co-founder and CEO of Locust Walk. We help biotech and medtech companies with strategy and execution of deals across partnering, M&A, and private capital raising. Nice to meet you, and look forward to the discussion.
Good afternoon, it's Phil Ross from JP Morgan, 20-year investment banker, the same firm with 10 different names: H&Q, Chase, JP Morgan, so it's a pleasure to be here again. I spend all my time on strategic advisory and capital raising with biopharmaceutical companies.
Always welcome. Good afternoon, everyone. Eric Tokat. I'm a partner at Centerview Partners. We are a strategic advisor firm. I spend 100% of my time in biopharmaceuticals.
Great, thank you everyone. So 2019 started off with an intense burst of M&A. Obviously everyone saw the Celgene acquisition by BMS right at the top of the year in advance of JP Morgan. But then the rest of the year was really smaller deals. There's a noticeable absence of any larger mega cap deal this year, and I think a lot of folks at the JP Morgan conference were a little surprised by that. I know I was. So to what do you attribute this lack of a mega deal so far this year? Eric, you want to start us off?
Sure, Ori, thank you. I do think the new era of deal making, science is driving all of it. So we're in the midst of a scientific revolution, I would say. And a lot of that is driven by the small startups, firms that are backed by venture capitals, really spin-outs from universities and the like, and they tend to become smaller deals, and Phil and others take public, and shortly thereafter, sort of in the sort of $1 to $5 billion range, they get acquired. So we have seen a lot of those deals last year. I think we continue to see more of those deals this year and likely in the future. Historically, the large pharma mergers really were driven by efficiency, cost cutting, cash flow, a lot of different diversification, a lot of different drivers that goes onto it. I think that in this era, the drivers are a bit different than we've seen in the past. So I do anticipate more of the sort of $1 to $5 or $1 to $10 billion deals in the next sort of few years here, rather than bigger pharmas becoming bigger. And last year, when you think about AbbVie, Allergan, or Bristol Celgene, the core drivers of those deals were, again, addressing some major sort of patent cliffs or generating cost cuttings and buying additional R&D capacity in a way to further do these smaller deals that we're talking about. So I just think the general trend is changing towards more of that smaller size deals than mega deals like we had in the past.
I would just add from our conference, there's a lot of discussion about M&A going into, during, and out of the JP Morgan Healthcare Conference. It's only been, if you take Celgene and Bristol aside, that deal was announced before the conference for one reason only: to manage employees, not make investors happy, right? You announced it a full week before. There's just like 75 to 100,000 people that need to understand what's going on in a large transaction. The last 2 deals that got announced on the beginning of our conference were actually Loxo and Ariad. And that's it in the last 3 or 4 years. And everything else, and there was a small deal that Celgene bought a company called Impact RX the Sunday before we actually helped them buy Juno. So Juno was bought the week or 10 days after the conference. BioVeritiv was sold, 2-3 weeks after the conference. There's a lot of buildup, but I would credit, there's a lot of deals that happened in the fourth quarter of the past year.
Well, as someone who's worked on some of those deals, I can tell you that the goal was to get them done ahead of the conference, but things took a little bit longer.
I guess what I would add to that is going back over the last 25 years and comparing the last 5 to 7 years, you're seeing earlier stage companies partner with larger pharmaceutical or biotech companies more often and earlier. There's more of a partnership and a collaboration now between sort of big capitalization pharma and biotech and smaller companies. And so in many ways, you're seeing, in addition to the fantastic M&A activity that we've seen, it's pretty common now for a company to go public that has one, if not two, pretty extensive collaborations with a pharmaceutical company. And many times that's sort of the initial step potentially towards an acquisition. And so I think that collaboration that we've seen is going to continue, and will continue to sort of fuel that $1 billion to $10 billion type bolt-on transaction that we've seen. I would say just keep in mind from a forest perspective, there's been $350 to $400 billion worth of M&A done in the last 2.5 to 3 years. So while we may not have seen as much in the first month of January, in the scheme of things, it's still very, very vibrant.
Excellent. So, Kim, between the trade war, CFIUS, the slowing economy, and now coronavirus, China has had a lot to contend with over the past year. What does that mean for China M&A specifically, both inbound and outbound?
That's 3 questions. Okay, so let's see. So in September, we had Amgen acquire 20% of Beijing for $2.7 billion, which was a nice transaction in light of the geopolitical situation and CFIUS, pharma, export control, etc. But the numbers for 2019 sort of recently came out, and in fact, M&A cross-border, China, US, is flat, but it's active. The partnering is actually up 30%. So it just shows sort of the interest on both sides in maintaining, investment opportunities in business, etc. So that's encouraging, right? So that's despite the geopolitical situation, regulations, etc. Okay, now what? So trade. Okay, so trade and CFIUS, pharma, etc. Just real briefly, I mean, my opinion is that that's a self-inflicted wound, that we imposed on ourselves. The reality is that, our biotech companies were benefiting greatly. The private biotech companies were benefiting greatly from the influx of capital from China for a number of years. And in fact, front page of the Wall Street Journal, 2017 or so, China's funding the future of US biotech. And that's gone down significantly, dramatically. So there's that. Coronavirus, very sad situation. We certainly wish our Chinese friends and colleagues all the best, but my sense is that this too will pass, and the fundamentals of China healthcare are sort of undeniable. So I'm positive about that.
So maybe I can add something to that. So we spend a lot of time helping companies with partnering cross-border as well as raising capital. And we're seeing lots of interest, not just from the Chinese companies, but from folks like you out in the audience asking, what can we do in China? So I think they might not have gotten the message that there's an issue, but I do think that it is here to stay, and there will be more deal making, as was referenced, with 30% up. I don't see that changing. If anything, it's going to accelerate. It will overtake the Japanese partnering in pretty short order from what we've seen. On the capital raising side, you're right, the amount of capital going to these small companies has gone down. However, we're still seeing deals coming out of China. We're working on a couple right now. We have term sheets that are actually leading these deals. So it has not turned off, I can assure you that.
No, I mean, I would argue that the licensing deals, the terms have become more Western-like. So we are seeing upfronts, equity, it's just a nice package, milestones, royalties. So that's the good news. Jeff.
So just building on that more on the licensing side of things, how do companies go about thinking about whether they're going to pursue an M&A or a licensing deal when looking at various assets? Jeff?
Yeah, sure. So I think these two gentlemen here are much more equipped to talk about how companies are bought. My experience is that most companies who want to do a license deal start out with that. It's rare you put a for sale sign on your front lawn and then actually get the company sold. And we've seen cases where companies, including a deal we did at the end of last year with Zyphos, when we were running a dual track process, we weren't even thinking about M&A, but Estellas felt they had to own the company, not just do a license. So fundamentally, it comes down to, does a company need the entirety of the asset or platform, or is just borrowing or renting sufficient? And that will ultimately drive that decision on the buyer side. On the sell side, it's a function of corporate strategy. I don't think M&A is necessarily a strategy to pursue. It's usually an outcome of good strategy executed.
A couple of things I would add. As the old adage goes, companies are bought, not sold. I think that is really correct in every sense of it. We think the best companies who will likely get bought are the ones who pursue the correct standalone strategy and execute along the lines of what I need to do to create value, become a sustainable entity, and take all the right measures around that. If that's licensing an asset, or if it's co-develop, co-partner type of a situation or whatnot, I think that's fine to pursue that. And in those discussions, we find oftentimes that if the potential buyer or the partner likes the asset so much, and the target, if you will, or the smaller company wants to retain certain rights that the bigger guy wants to also retain, then they convert that into M&A. In the last several years that I've executed towards the end of the year, whether it's Arcule to Merck, or Synthorix to Sanofi, or UCB, Ra, or Kilian, Alexion, etc., they all have started with partnering conversations. And after a while, there was some mismatch of perspectives on which rights to retain, which rights to give away, and the bigger guy basically said, I'd like to acquire you and turn into M&A. We think that's the right strategy for anyone, quite frankly. Putting a for sale sign is just not the right tactics today in today's M&A environment, because the deal making is very efficient, and in the past you'd hire a banker and say, hey, can you run a strategic alternatives process? And the bankers would call many players and try to sell the company, sending out first round bid letters, second round bid letters, etc. Today, I think it has changed. I think today, the BD teams, internal BD teams, or the people like Jeff and Jeff's team, helping the internal BD teams, thinking about partnering, spending time with the buyers, and when and only if that buyer raises their hand and to acquire the company, then I think we all can do a good job maximizing that value for the companies. I do think that's the new game, if you will, the way to do it, not to put a for sale sign on the asset.
The other very key component in licensing is we're now in a world of enabling technologies. There's so many combination therapies that are happening there, technologies that need one another to actually create a best-in-class therapeutic. And it's only until you get to a point where the tipping scale of I want to own that and keep it from somebody else does it turn into a really high-quality M&A deal. And then when we have a really good spigot open on the capital markets, it actually makes people want to do a little less restrictive licensing, a bit more playing around. So you see a lot of these non-exclusive licenses, whether it's in areas like gamma secretase inhibitors for BCMA, or in the old days, IDOs, ways to create the tension that it ultimately tips the scale.
All right, so we're painting a picture here where it's still a very robust environment, a lot of demand. We're probably looking at smaller deals in the $1 to $5 billion range. What about particular areas, therapeutic areas? What are people most interested in? What's hot in terms of where you see a lot of interest from your clients?
I would say the biggest area actually isn't necessarily the therapeutic area. It's really big data. There's never been more data being generated pre-clinically and clinically, and making heads or tails of it, and understanding how to analyze the data, and specifically what types of patients are going to respond better to a certain therapy, which ones are going to have a better therapeutic profile. So, in all the conferences I go to or meetings I have, talking to some of the largest companies and even the smallest ones, the recurring theme is how do we make sort of heads or tails of this data, and that's sort of why a correlate of that is in the healthcare tech and tech-enabled services sector. You're seeing another renaissance. We have renaissance here in innovation that we talked about that's been going on for a decade and a half or so, and that's leading to a lot of sort of derivative fantastic development innovation going on. And so I think that's going to be a very unique, continue to be a very unique symbiotic relationship between discovery and sort of analyzing data. Likewise, I think another big area we need to focus on as well, and I think will continue to be important going forward, is manufacturing as well, particularly in the area of cell therapy. It's again, I call that an unmet need, if you will. And I think one of the panelists in the last discussion was talking about that in gene therapy, and I would agree. Coming up with a standardized, efficient way of producing clinical and commercial scale these cellular therapies, particularly on the autologous side, is a clear unmet need. I think the other big one that I come across a lot as well is the immuno-oncology, immunotherapy. Despite all the great news and a lot of the positive developments, the response rates are good but not great. So I think there's still a need for how to improve it. How do you change the tumor microenvironment and make it more susceptible? The cold to hot, we hear that a lot. But that is another, I think, sort of big unmet need before you start talking about all the different therapeutic areas.
Just add briefly, thinking about modalities, everyone talks about cell and gene therapy, and that is obviously the next wave, the next generation to get hopefully cures or prolonged duration of response. I think if you actually look at the deals that are getting done, there's still an awful lot of small molecule deals getting done, and there's an awful lot of small molecules actually getting approved by the FDA. So you have to make sure you curb your own enthusiasm relative to the new stuff, and don't forget there's still a lot of value in the traditional types of assets.
Just a couple of things to add. I think from a therapeutic area perspective, I would say majority of the M&A deal making happened in two core areas. That's oncology and rare disease in the last several years. I would say in tune of 67% of the deals greater than $1 billion were in those areas, excluding the big pharma deals. I do see that continue, and it's a little bit of a supply and demand. Again, today, if you look at we have about 110 companies greater than $1 billion in the market cap with market capitalization, and about 50% of them are in oncology and rare disease. So the supply and demand is there. Other areas of interest for the large pharmas continues to be immunology. I think that's a very big area, immunology and inflammation. There are very few assets that are all differentiated. I would say CNS again continues to be interesting, but by and large these are the core specialist areas. The key theme though is again disease modifying, curative, transformative, etc. I think the old deal making of reformulated drugs, 555B2 pathways, I think they're a lot less interesting for the larger pharmas. I think people focus on high science, and quite frankly, any therapeutic category will have a differentiated target drug profile that has a meaningful impact on the current standard of therapy. Will have a great shot at the big pharma from an M&A basis.
I would just say precision oncology is the hot word these days, specifically on the small molecule front. The immuno-oncology world has become really, really challenging for people to figure out where they're stepping into the growth curve in terms of what is the next best thing out there. And even in precision oncology, it's hard to tell if that's truly a rare disease or not. So it's all about mining the mechanism and seeing how far it can go. So that's the exciting part. Is can they model beyond that first or second indication or that fourth or fifth line approval to get up to second line to increase duration of therapy, long-term patient value.
Just, and from a modality perspective, I completely agree with what Jeff said. I think in addition to small molecule, though, we're seeing gene therapy to be a little bit more mainstream than a few years ago. Cell therapy is sort of further behind, but still people are sort of thinking about it real hard. We hear a lot of this digital therapy in health IT. I don't know what that really means yet from big scale M&A basis, just scarcity of assets. But people are talking about all those different areas.
It's interesting to me that you didn't mention a couple of really big areas that have had some huge failures. Maybe that's why. But one is, metabolic diseases and diabetes and obesity. That's such a huge problem in this country. And the other, of course, is neurodegeneration. There's just been, a landmine of failures recently, but there's a lot of very early stage companies out there with very different approaches neurodegeneration. Are bigger companies tracking all of this? Obviously, how are they thinking about those areas? Which, between a growing population in terms of physical size as well as a aging population, those are going to be two critical needs for the country in the next few decades.
Yeah, so looking at it from a small company perspective, it's really hard to finance in the small company context some of these metabolic diseases. And so that tends to be the purview of bigger companies because you're going to hit a cliff on what you can finance as a standalone entity, and that puts your back against the wall relative to doing your own development and discovery in that area. So I've seen a lot less of that, and that's partially because of the dynamics of that specific business.
We had the opportunity to work on the medicines company transaction, which I think there was a lot of M&A quote premium in the stock even before it got its premium. But it took an N of 1 in terms of interest. A lot of read the background. 6 or 7 people like to show up to the dance, but only one did. So it's a tough space when you think about. But neurodegenerative disease will be what ultimately could bankrupt this entire system because it's the biggest problem out there. I only hope that Biogen gets the other side. I saw a setback this morning. It is literally the third ramp for people to touch, at least Alzheimer's. Schizophrenia, bipolar disease, all getting very exciting. There are a lot of exciting things going on in intracellular stage, other places, but everyone has to go through this really tough path to get there. I think it will continue to be very high for those.
It's typically these big diseases have been areas that biotech has stayed away from in large part because most companies wanted to develop products where they can conceivably commercialize themselves, which is segmenting diseases and having more specialist type of marketing and detailing channels. But in light of what they call the capital formation, the company formation is happening. These earlier partnerships that we referenced earlier between big pharma and biotech and some of these small companies, sort of spreading the risk, it's enabling and enabling to try and take some of their fantastic technology and apply it to these larger diseases. Otherwise, clinical alcohol, as we just discussed, really hard studies to run. And also, sepsis is another one but potentially is some interesting in that one. So I would say this is part of the continuation as well.
All right. On a brighter note, in the last few years, we've seen a lot of early stage companies, Series A companies, raise hundreds of millions of dollars. How are these larger startups tracking towards IPOs? And what does the window look like for some of those companies to go public this year?
So, yes, these $100 million plus A rounds are real. Actually, the ones in China aren't as real. They talk about 100 and they take like 28. Here they've been real. And the capital formation on the early stage A and even early B side have enabled companies to take a platform more broadly. And then they can access the public markets. We just did a great deal for a company called Beam Therapeutics last week. It's a single base pair editing company. It's phenomenally cool, and it's going to take some time to play out the capital markets. Those technologies are going to be, when they are financed by folks, we're finding that the buy side in particular is willing to lean in on biology. And they feel very comfortable compared to what we were 15 years ago, where biology can take you, the ability to adapt, and the speed of the curve to get there. It's a trusting state, so you have to execute on your own homework. That being said, we tell people to go public when it's right for them, not just because like, oh, the market's here, just the companies are wrong, right? You can't sit there and manufacture a successful capital markets debut if you've never met an investor before, if you don't have a high quality syndicate, if you don't have the right public and private hybrid investors in the company. The one thing you don't really need now is the validating partnership. That was the theme from 2004 to 2014, and it's kind of gone away. And folks like to think about retaining assets for the future. So we haven't seen that spigot shut off yet. And most importantly, because most IPOs are done before you go on the road. Follow-ons are a whole different discussion. It seems pretty easy to access the market with the right.
Yeah, I mean, you need news flow. You can't just say, I want to go public, and therefore you're public. Something has to support the stock in the aftermarket. You have to have a pathway to create value with that capital. And a lot of these companies that have raised so much money, they actually have to deploy that capital and generate value before you can even consider an IPO. So if they just raise money, I would say there's probably a bit of time that would be needed for them to cook it in the oven a bit more, versus if it was a few years back, I think you might be able to move it further along.
So the time to go public is extending a little bit for some of these companies that are raising the large private rounds.
It's not necessarily it's extending, but if you raise a bunch of money, you have to do something with it before you can then raise more money. You can't just continue to raise if you don't have anything to show for it.
I would add that the definition of what a metric of success is needs to be carefully articulated to the market before you go have that conversation. And that could be with investors, partners, whoever it is, because you may get a patent, you may figure out how to manufacture something, as Andrew's saying, a really hard path. But investors may not care that much about it, but it's critically important to create value. The earlier you go public, the more lumps you can take in the public eye, right? You only get one chance to create the narrative. So controlling that in the public domain as you have fits and starts, whether it be everyone's talking about IND in 21, first patient data in 21. That just moving those goalposts by 3 months can really impact your stock in a big way. If the stock trades down, people don't necessarily want to defend it in the public market. They're very happy with the position they have. So it's interesting, but it's less about news flow than it's more about making sure you can handle those metrics of success and what may be important to you may not be as important.
And I would, I try to stay away from sweeping statements. It's taking longer to go public now than it did 3 quarters ago, getting that specific, or last month, or 2 years ago. In my experience, companies that we've worked with that have raised these significant Series A or $100 million, it's really generally for 2 reasons. One is it could be because they have a great management team, they have great technology, they have significant use of proceeds, and need to invest in some meaningful catalytic events that are coming up. And they choose to overfinance the company so they can take the time to sort of make their way through those events and not be beholden to or the public markets for the next one. It gets them a little bit longer. Others view this as a necessary step to go public because they want to bring in that public-private investor that facilitates around an IPO in the next several months. So it's a very good situation. And the good news is that when you look at the venture capital universe, the amount of capital that's been raised has been, as we all know, incredibly significant. Company formation continues to be very vibrant. Based upon the last couple of weeks worth of IPOs, the market is generally still very well receptive.
Just following up on that a little bit, there have been a large number of IPOs in biotech, obviously, in the last few years. What do you see as the need for those companies that have gone public? Are we going to have a lot of follow-ons coming up this year? How do investors think about investors that are already in this stock? How do they think about supporting their existing public companies in their portfolio, looking at new public companies, either existing public companies or companies coming public?
I would say, on average, going back to now sweeping statements, on average, the biotech industry, particularly in the small mid-cap world, is very well financed, particularly if you look at it historically. I think if you look at the last 2 years worth of IPOs, I think 80% of them have more than 2 years of cash. So less than 20% have less than a year or so of cash. So they're pretty well financed. And that's usually the metric. You want to have at least a year and a half or so of cash. So I don't think there's an extraordinarily pressing need just to finance. And what we've seen, clearly is that companies who are public already tend to finance pretty much automatically after a significant event. It's a whole other conversation about how do you minimize the financing overhang as you head into data events. And there's companies that have done it right and companies that haven't done it well. But to answer your question, generally speaking, the run-of-the-mill typical biotech company is very well financed, and you would expect that given the amount of capital that's been raised over the last 8 or 9 years. In terms of the other part of your question about how do public company investors look at putting capital to work in a new investment versus defending an existing position, if you will, I think it's very sort of company or thesis specific. You can sort of try to draw connections about areas that they feel more comfortable in, different therapeutic areas, maybe areas where they've had more successful investments than in others. There's probably a bias towards that, but in my experience, in the number of transactions that we've been involved with over the last several years in building out books for these deals. There's no real defining set of circumstances. It's very much thesis dependent. And of course, it's all governed by sentiment, risk sentiment. In periods where risk is on, I think you tend to see certainly more generalists participate. And when we've seen periods in the last couple of years where it's been a bit risk off, and it's been more club style, specialist type of investors. So I don't think there's any really one specific reason. I think it just depends upon the company and its own specific thesis and upcoming milestones, what they're financing.
It's temporal and opportunism is what gets investors a little antsy. So the first one is a temporal. You get into a fourth quarter like 2018, where the market's off like 20%, the world's falling apart. They don't really want to put money to work, even on a great post-ASH data event. The other thing is we found a lot of companies will finance when their stock's up. We call it an opportunistic versus a catalyst-driven financing. So if the stock's up 30-40%, they may just hit the button and go without having had a big event take place or some sort of de-risking event. Those books tend to be a little less sticky, and they also tend to have a little less pro-rata investment. A lot of the investors still support their core holdings, but they may not be, if they own 15% of the company, maybe they're in for a 5% pro-rata instead of 15. So it does have a lot to do on if it's opportunistic or not. And then the other we find is they're financing off of 52-week highs that are under 70%, even if they are opportunistic. So they're 30-40%, but they're still down a lot year over year. So either way, look, capital is the oxygen in the system they need to breathe, and it's really important to do so. There's still $15 to $20 billion a year in follow-on issuance. Maybe this year will be a little different, who knows? People always come out swinging the week before our conference if it's a full week off, and then the week after, and then up until this week. There's staleness issues, but that's going fine, just fine. What's available to you as a newly public company, it's unfortunate. Companies, they have very little technology they can use to raise capital. Pretty exposed. So you're marketing for 2 days, you have to do a pipe, and it's your S1 registering, you don't have a shelf. All the technology makes it easier for people to actually access the markets. It's really hard to do this first year public.
So you talked about having, a year and a half, 2 years of cash on hand, biotech being, less interesting to general investors in a risk-off environment. So with the recession that the general media has been talking about is impending for years and years now, how do those macroeconomic trends affect the biotech industry? Or is it more insulated because of the capital, or is it less insulated because the generalists flock away? How do those balance out?
I think they would affect. There's no question they wouldn't affect. I would say, and sort of if the macro turns into a grim view and all these exogenous factors and the market goes down dramatically, I think there's a broader correction. Biotechs will certainly have their fair share of it. But having said that, I think. I would answer it in the context of, I get this question from an M&A cycle, are we at a peak? People do ask all the time, and in late cycle we tend to peak, etc. And my general response to those is, I think for biotech, I think this time is really different, because if you look at the prior peaks, and the deal making in biopharmaceuticals have been more around filling in a revenue gap or cash flow driven, etc. I think the core drivers now is, as I mentioned earlier, science driven, and I think we're just in the first or second inning of the scientific revolution. Therefore, I think as the science delivers, I think we will continue to see deal making. They could be at a lower valuations than we are. I mean, there is no question. I think valuations are meaningfully improved over the course of the last several years here, both from the private valuations as well as public valuations. But there's no question we will be affected, and this year we are actually going through a time of uncertainty with respect to elections and drug pricing, etc. I think all of that, which we can talk about, I think are a bit out there, right? I mean, those could derail some of the things we're talking about here, at least in the short run.
I mean, just a few things to add to that. I mean, there's so much money flowing around the system that there would need to be a burn-off period, that if things did turn, that it would have to cycle through. All these companies have so much capital, a lot of the investors have so much capital, and so they might hold off investing, they might slow it down, but there's still enough in the system that even with some exogenous factors that you'd be able to maintain things for a little while. And I remember back in the fall of 2008 when I actually started Locust Walk, you could only raise capital through partnering. There wasn't an IPO market. And you know, the industry made it through, and it's just part of the cycle that I'm sure at some point will come back.
We should follow the money a little bit too. So over $100 billion in the healthcare funds flow have come in through passive money. That's our 401ks collectively in this room where we want to allocate it. At the same time, like $100 billion came out of actively managed funds that we go on a roadshow and talk to every day. So if the world becomes incredibly risk off, we all decide to pull our money collectively from this country around the world out of equities. That's where you're going to see a devaluation of all assets, not just in healthcare. Anything equities and ETF related, almost every client has at least 3 to 5 index funds in their top 20 investors. And it's kind of, who's going to vote this way or that way. And when you look at it, you say, they're not quality demand, they are real demand, they true up in the deal, but that's unique to this current cycle we're in right now. So as long as we don't get completely risk-off equities, we should be okay.
So you brought up politics a little bit. The panel earlier today was talking about pricing and talked a lot about the political environment in terms of what that means for the pricing debate. But what does that mean for the M&A market, for the capital markets? You know, there's the conventional wisdom, I think, is that there's a lot of action in the first half of the year and then it slows down as we approach the election. But is that actually what happened in prior years? Is that in your experience, or is that just an old wives' tale?
Capital or M&A or both? On the capital side, I went back and looked at the 2012 election and the 2016 election. 2012, interesting because we're coming out of the markets were set up to tear, and they did tear. So that one you take to the side. So you look at the 2016, there were 10 IPOs that happened by the middle of the year. It's really hard to go public in the middle of the summer. You have the RNC, the DNC, and 2 FOMC meetings, all those acronyms, but they take up all the time and the airspace. And then when you head into, if you remember 2016, the only IPO in the world was Editas. In the world, any industry was Editas. So you kind of knew the feeling and the sentiment. Everyone's kind of lining up right now to say there's less uncertainty today because there's nothing priced in the market about Trump losing at all. If it was priced in, you really feel like you're having a much more sober conversation about some of the other aspects of what could be going on in capital raising. So there's a lot of people that are pushing pretty hard. We also couldn't go public this time last year. The government was shut, so you're seeing normal deal activity today. If you fast forward to 2019, like 48 IPOs last year, but the first half of the year was still lighter. It was like 20, 30 second half. So the other problem is you run into after Labor Day, it's just really hard to raise capital. You get like one little window, and then you're kind of right into the election cycle. So and then on the macro side, I was saying M&A, and I welcome European Americans on the panel. It's those big topics: taxation, repatriation, all the stuff that can screw up a model for someone. They're trying to do their math. Because we're really lucky right now, because the larger guys are trading at multiples that are really high, and the larger biotechs are actually trading multiples that are really low, and that's the first time it's usually flipped completely around. So being a big, diversified, big company, you're getting rewarded in today's market. You're a safe haven, and they feel good about their business, they'll buy companies immediately. If they feel less good about their business, it's very hard to buy companies.
No, I agree with all that. I think there's no question. I think towards as we get closer to the election, I think people will become more nervous, and I think typical that sort of June on, we're a little bit just in the waiting mode because all the things we mentioned about the conventions and the election, etc. So I think, but today, I think as Phil said, I agree. No one seems to have priced in any potential risk of the election derailing anything. I think the activity is there. I think M&A pipelines are as robust as it has been last year. And by the way, we didn't talk about it, but last year, I think from a biotech M&A perspective, $1 billion grade, I think was the highest volume year from a number of deals perspective, which is higher than we have seen in 2014 and 15. And if you actually dissect the type of deals that happened 14, 15 versus last year, it's even more profound because last year was again in 14, 15, a lot of that deal activity was driven by inversions and spec farm, the companies Valiant and Ando and Mallinckrodt bought, and only 3 or 4 large pharma deals have happened. Large pharma as the buyers, if you will, have happened in 14, 15, whereas last year there were 9 deals that were bought by large pharma. So all of that, I think, to say that the cycle is actually going to go and continue very, very robustly. So barring, again, a major exogenous factor, I feel we're going to keep seeing it. With respect to pricing, I'll just touch on that. I don't think market is pricing, nor we're thinking there's going to be anything dramatic that's going to come out. I mean, they may come up with something that both sides may be looking like they're winning, if you will. But I don't think people are pricing any radical change on the high price drugs or anything like that. All of a sudden we're into a different regime like Europe has gone through or anything like that. We certainly don't see that. If that does happen, which I do think very, very low likelihood, if it does happen, clearly will have implication on valuation. I don't think it will have major implication on deal making, but it will have implication on valuation. And the way it works with deal making is, the sellers will need to have some time to adjust to the new era, new pricing. Because a couple of years ago, as Phil was mentioning earlier, when there was a dramatic, correction in the life sciences market in January, you may all remember, in 1 week's time, stocks were down 30, 40%. And for about 6 months, there were no real deals. And the reason there weren't is not because buyers didn't want to buy, it was more sellers were not, because the pricing memorandum kicks in and they say, I was just trading twice where I am, why am I going to sell right now? And so that takes some time to readjust, and then we start seeing things happening again.
And I would just, agree with all that. I would just add from the capital raising side, just anecdotally, in the conversations that we've been having for the past 6 months, my sense is that boards and executives are trying to manage around the election, trying to pull forward finances for this year, and those that look like they're being delayed for whatever reason, they're sort of writing off the second half of the year and just waiting for the election to be over before they go back. And I tend to see that maybe a bit more on the IPO side than I do on the follow-ons. I would think that catalytic type follow-ons where there's good news could probably finance, and historically have been able to finance virtually in any market. It's a function of where your stock is at the time relative to where it was before the market disruption, but at the end of the day, capital is oxygen, they tend to take the capital. But barring that, from just a fiscal planning perspective, I definitely sense from boards that they're trying to manage the second half this year, either do before or after.
So it really is as simple as Trump's going to get reelected unless we see polling or performance in the primaries that tends to think that we're going to have a Democratic president and a Democratic Senate, and everything else is just noise, and the market just maybe reacts for like 2 days and then sets an all-time high again. Is that simple this year?
Yes. The challenge is that, as of right now, there's no clarity on who's getting the nomination. If one of the more moderate candidates starts to pull ahead, that might actually make things a little more uncertain, as opposed to some of the more left-wing candidates. I think ultimately will create more certainty in the market of re-election.
We were super lucky to have the private bank come teach us in our political strategies the Sunday before our conference this year, so we thought we'd have a clue talking to our clients. And they came in, you can look it up online, they do this algorithm to come up who's most left. Biden's actually more left than Obama was, if you do this math. So it's actually worse, right, when you think about him emerging. So then it comes down to basically Bloomberg at that point. So most of the time in these elections, it doesn't even materialize till May, June. Who might be the candidate, the opposing candidate? It's not priced in. There will be volatility. I don't think it's that simple. It's never that simple.
That was my concern.
I don't know, this guy who I work for, Jamie Dimon, says something's going to happen. We don't know what it is. We didn't know coronavirus was going to happen, and boy, that took a big. We're starting to understand the implications, how that ripples through all manufacturing. So there's other things that we can't control, which are likely to come into place. So I'm expecting not the R word, but something dramatic could happen that could take us off the rails a little bit, and we get right back on.
You want to hazard a guess across Wall Street? What will be the single biggest thing that happens to biotech specifically, not the street more generally, but to biotech specifically, that will affect the industry? Is it some new scientific development? Is it coronavirus? Is it China? What do you think could be the one singular event that next year at this time you look back and say that's the event that defined 2020? Let's set the election aside because that's the obvious one.
Okay. I'm going to say China. The reason is that one of the top, what boards are asking or saying, one of the top 3 questions that boards are asking their public and private life science companies is, what is your China strategy? And from what I understand from our industry organizations in Washington, I was there last week talking to some top people, that they're getting a lot of heat from the biopharmas in this country to resolve the issues with China so that they can get on with it, accepting capital, doing deals, etc. That was not the case a year ago. So the heat is coming from within. I think, you know, the large biopharmas they've been in China for decades, so that's nothing new, right? But they're increasing their exposure and they are making significant investments. And so, you know, that's sort of interesting to watch. Something that is reasonably new is that our biopharmaceutical companies are looking at innovation coming out of China. And, you know, they read, so they saw one of the articles, front page of Bloomberg, China is finding cures to cancer faster and cheaper than any place else in the world. So, you know, business, the momentum around doing cross-border business with China will continue. There's going to be a lot of sort of uncertainty and risks associated with that. But, you know, I just think the momentum's too strong.
I would sort of give 2 answers. One, I do think the coronavirus issue, which is China-linked, is having a real effect. I would just say I know of a number of companies that are U.S. companies that are in the process of doing deals or partnerships in China, and it's just totally shut down. So I don't think we understand the full magnitude yet of the ripple effect from that. That's sort of number one. Number 2, when you go back and look at the last 5 or 6 years, what has been most disruptive to biotech, it's been anything that has resulted in sort of a risk-off mentality, and the most profound of which is, tends to tie back to the yield curve. And that brings up the R word potentially. So anything that sort of looks or smells like that, I don't even want to say it, would probably be the most lethal sort of thing, if you will, to this expansion that we've been undergoing. That aside, when you go back and look at geopolitical concerns, there's been a fair bit of those in the last couple of years. The market's been extraordinarily resilient in the face of that, which is very different than it was generally historically. And I think that has to do with where the rates are, which is ultimately the key driver. But the only time it's really been really exposed has been when it's more recently the yield curve or anything that sort of looked like the economy was slowing. So corporate earnings continues to be something we look at very carefully. So I sort of put those two, maybe the black swan events that could derail this train.
So I don't have a crystal ball, and if I did, I'd probably start a hedge fund and not tell you the answer. But short of that, I think the other R word, reimbursement, if that comes out as something that's more of an election theme. The last time I remember in 2015 when Hillary Clinton did some minor tweet, the market in biotech just fell off a cliff. So that is a risk that I can't quantify, but if that comes up to be a bigger part, I think that will play a role in biotech.
I just that biology and AI will drive a lot of really big enthusiasm. I don't know if people are going to buy it, like when you say I want to buy your company, but in terms of breakthroughs in science, discovery, and applying science and mathematics into understanding biology is going to really change that. Obviously, risks to the down, I would put in safety. Can the system handle one really bad gene therapy safety event? Does it take them all down, or is it just designed to one silo company? We haven't seen it yet. I hope we never see it. So I think it's really important to understand that. And then lastly, is the reason the pharma sector is vilified a lot because they don't do a lot on their own to get in front of it. So how do you deal with it as an organization on pricing instead of talking about how much drugs are as a percent of GDP that's spent on healthcare, which we all know, and the net effective price? There's a lot of discussion going on about how can you as an organization, as a group, kind of control the narrative and make it your own. And it's very hard because of all the rules and regulations against the companies and what they can and cannot do together as a group legally. But there's got to be a way to break through that on a policy level. So keep away the vilification, no safety, major blowups, and AI, biology is great, capital still flows. We should be in a better place this year, maybe the same guy residing in the White House than, we are this past year.
Yeah, so a couple things. I think first, when we sit here next year, we'll look back and say it was a great year for biotechs. That's my general view. But what could derail this view, I think for biotech specifically, and that is tied to reimbursement, pricing, etc., a Senator Warren or Sanders nomination, and furthermore, potential election, I do think low likelihood, but if it does happen, I think we're gonna have a very, very different biotech valuation environment and a lot of unhappy investors, etc., is my guess. If that does happen, I think that's low likelihood, but if it does, that would be the biggest, in my mind, effect as an industry generally. And as it relates to the global macro impact, I do worry about coronavirus a lot. I think people are underestimating how severe that could be. I don't know if it is or not, but I think if it does, this 400 million people locked down is not something to just brush off like market has been brushing off. And so if it does become a global pandemic, then I think we're going to have a bigger issue globally as a macro, and not biotech specific, but macro. That would be in my mind the last one for this.
So, as the lawyer on the panel, it's incumbent upon me to ask. Now you mentioned regulation. Is regulation going to have a big impact this year? The antitrust regulators, kicked back a couple, the PacBio Illumina deal, the Spark deal, and there's been a lot of antitrust activity in the biotech sector. Is that going to continue? How are you thinking about those issues?
It does affect clearly the biotech deal making. I've done the Spark deal as well as my partner did the PacBio deal, so we lived through it, and a number of deals that we've done also taken further scrutiny than historically have been. I think again, if the commissioners are there 3-2 Democratic, vote against Democratic. Again, if the administration flips, I think then that'll have a major impact, no question, among many other things. I don't really see it as potentially derailing or making deals. People are not attempting to do deals. I think people just be a little more careful and will take more measures around that. That will clearly have an effect, but I don't see that as in the bucket of the others we talked about from risk.
So no CEOs are dialing back the risk in terms of not going forward with the deal because of potential.
Well, I would say if the PacBio deal was happening today, that would be a different discussion. Spark, for instance, there was zero discussion in the boardroom around potential risk of antitrust here. But then when you think about an Achillion-Alexion deal, there was a ton of discussion around it, but then that got approved, albeit a bit later than your typical 30 days, but it did get approved. So I don't think people are overly concerned about, oh my God, our deal's not going to get approved. But they do all realize that there's going to be greater scrutiny by FTC than historically have been.
Most large-scale divestitures are actually messaged as part of a FTC-related discussion in a boardroom. So you didn't see Tesla discussed the day that Celgene was mentioned. We did all the diligence. We evaluated Type 2. It's a really cool mechanism and assets. But to say that all the airtime was taken in the room on Tesla, it wasn't. It also would have been discussed as a potential divestiture at the time of announcement. So when Allergan AbbVie happened, they actually announced they had to get rid of their IL-23, had to get rid of Zenpep. They just announced that they got rid of those products last week or 2 weeks ago. So, but I think it's the threshold that the seller is what you're asking about. At what point, what's the tipping scale on the sell side? And the contracts, people are going to try and get a little tougher on the contracts, and hell or high water is a tough thing to get, which means basically I as a buyer will sell whatever I have to close on your deal. But there are bridges to those gaps, and there's ways to come up with it to make it more palatable on both sides. I would say on the Spark deal, that was a pretty tough stance that was taken against them. There's so many gene therapy players in hemophilia out there, forgetting the fact that they have Hemlibra. There's enough participants, but it's a hot button. So you have to evaluate that internally. And maybe as you go through your final bid, you may find that you sell to the second highest bidder as a result of FTC risk, and that's legally allowed because that's about deal closure and risk to your shareholders. So some of that may emanate to the boardrooms as well, but we'll see where it takes us.
All right, we're coming up towards the end of our time here. Was there anyone in the audience that had any questions for the panel? No questions? Okay. Sticking on regulation, the FDA, there's a new FDA commissioner. How are clients, companies thinking about the FDA now in terms of, obviously, Dr. was very, very good for the industry, and is Dr. Hahn going to continue?
I'll talk about the CFD.
I would just say that, at least from what we're hearing from companies, is that they do expect it to be largely the same. They don't expect any significant changes again under this administration. I think it's been pretty clear generally what their policies are and perceived as being very pro-industry. So there hasn't been any significant changes or even hints at significant changes to the status quo. And so again, anything actually thinking about potential downside, anything that does look like it's going to be less collaborative between industry and the FDA would potentially be a negative, but I don't foresee that happening, nothing that we've seen, so I would continue to say it's probably business as usual.
I would just add, outside of the commissioner, there's the whole AdCom and PDUFA date. We've seen almost every client get punted 90 days on their PDUFA date. We've seen AdComs disappear, come back, disappear, and come back again for the same companies in a 6-month period. So there's a lot of confusion that takes place, especially for public companies. It's actually not fair to them to have to go through that whipsaw with their investors in the markets. And some of these AdComs are used as a public forum for the FDA or people in regulatory authority to make a spectacle of some of these companies, to prove an example. I don't know if anyone saw the Nectar panel that happened during, I think it was during our conference. It was 29 zip against 29 or something. It was like, I've never seen that before in my career. And it was really, they called them in there just to yell at them about the opioid crisis. So it's not just the commissioner, it's just the whole package. But it would be great to see, because you guys pay a lot of money in these PDUFA fees, right? It's a very expensive proposition for our industry. They hit them on time, they get the information on time. But on the other hand, people are doing rolling submissions, they are getting approved. It has been, I think, pretty cooperative compared to where it has been. I expect it to continue.
The view in China?
Yeah, no, I would just say, I don't think people realize one of the reasons that the life science industry has grown so quickly and there's been so much attention from the West on what's going on in China is that the regulatory system has changed dramatically. And it's changed dramatically because the Chinese central government's very smart in that they just hired a bunch of former FDA officials. And so they're mirroring our system, which is terrific, but I'm very hopeful, that's one of the reasons why, because it's being done sort of to standards that we're used to.
So, one other random question for you folks. So, we've seen a few direct listings in the tech world. Do you think any of these biotech companies could ever pull that off with stellar management team and great product lineup and good data? Could we ever get to that point?
Well, if I remember, it was it Thomas Wiesel or Bill Hambrecht when they started their own thing? They were doing these Dutch auction offerings. Remember, originally for a little while it was an electronic trading platform. I don't think it does what you need the most. Some of these IPOs are very clubby to begin with, especially in tougher cycles. To do a direct listing, you have to be large and liquid and have a very large and liquid secondary private market. But no one realizes a lot of the value in the tech world is actually exchanged well before the IPO. And when you go through those last 2 or 3 cycles of private financing, there's a lot of money, ownership changing hands, and not all going to the company. In the biotech world, if you go to sell any secondary private shares, that's the vulture market. People don't view that as a premium price market. It's very rare that people do an exchange or a buyout. Actually, there were a couple of exits before that went public because they didn't need the capital. So in order to have one of these markets where there's this kind of frothy demand without without the support of some of that secondary world, which is very large and liquid in tech, it's going to be pretty hard. It's not without trying, but I think it usually ends up, it's kind of the Form 10 is what they're doing today, right, in the old days, but that's not what you're talking about. You're talking about Spotify or some of these, Slack or some of these tech names that did that.
Yeah, something more akin to that than to a, just like a uplist from an OTC to a NASDAQ, after a period of time on Form 10.
I don't feel it happening so fast. I don't know if anybody else would.
No, I don't. Not at all. I mean, maybe there's an uptick in SPACs, believe it or not. I'm hearing more about that, and that's a little more structured and on the M&A side. But I hear that before I hear any talk about direct listings.
I guess I would think of that more as the reverse merger world than direct listing in that sense. So,
the reverse merger world actually is I guess a number of things. One of which is it shows that biotech companies can stay around for a long time. It's very rare for one just to sort of go out of business. And reverse mergers, although clearly not an ideal way to go public, do serve a very useful function. And to the extent that we've been involved in those processes, they're actually extraordinarily competitive. And if you are the public company, you have pretty quickly you have a pretty significant set of acquirers that are pretty interesting. And so it's a nice sort of bid, if you will, that the marketplace has when you have a company that fails and their only asset is their public status, which is worth, if you look at the deal, $7 to $9 million, and then your cash balance. So it actually it serves a useful function for investors. You have that sort of that backstop bid that's there, and I think you're going to continue to see those. There's several in the market right now that are reasonably active, and you sort of always have that background activity going on.
Yeah, and it's interesting that if a company, if there's ever a dip in the market, it's a good backdoor to get public where you don't need to do the crossover, take all the time, file this one, all the other fun stuff. And also, where else can you get capital that's fairly unencumbered, where you don't have all the strings attached you typically get from the venture capital community with your next round of private financing. So there's a lot of allure and there's a lot of competition. We actually were working on a deal that I think it was right. It's $5-10 million value just for a shell, which it blows me away that can have that much value. But there is a real market for that.
Yeah, I don't really understand how they're worth quite that much. I think a lot of times when I've seen the reverse merger get done and have a much bigger sample size probably, but it was the institutions that were in the stock before the failure that led it to become a reverse merger candidate have long since sold out, and what you're left with is a disparate retail base that isn't even following the name necessarily. So for the private company looking to be acquired and thereby become public, are they really getting the shareholder base they think they're getting, or does the work begin anew the moment they go public?
You're definitely not getting the shareholder base, and I don't think that's the motivation for it. I think the motivation is let's do an arm's length transaction to get public. So I'm a company and I have a desire to go public, and I'd rather have an arm's length transaction, minimize external variables like markets and general investor sort of mood and sentiment, and I just want to be public. And if they have enough cash at that point, which usually they will, they could generate value through clinical developments, and they sort of replicate the IPO synthetically through a follow-on or a second follow-on, and they tend to do that on a marketing basis instead of a confidential marketing deal, so they finally get in front of investors. And the thinking is a public company has more financing alternatives and investors than a private company would. And so it's usually not because you're absolutely right. At that point, when a company is pursuing a reverse merger, the shareholder base is destroyed.
You have to rebuild the shareholder base, and so you have to rebuild your Wall Street coverage. There's a whole. It's not easy to do, but it's certainly easier than raising more money in the private markets if you don't already have the right institutional investor base.
I think the key may be to have enough capital as part of the public company shell to really get through those value inflection points in the news flow to push it out, rather than having to raise on not great circumstances.
These processes are so competitive that the ones that tend to win are coming with capital. It's not just the capital in the public company, but they're coming with investors that are invest basically concurrently with the closing of the transaction. And if you don't show up with that, you're probably not going to win. So you do end up being public. Granted, you don't have the institutional shareholder base that you would want. If you have a public shell and you've got the money, now you have the time to go build and execute a plan and bring with it the investors at some point.
I do remember in 2016 it was very competitive for the reverse merger public shells. It was pretty competitive market. As we're about to run out of time, I just wanted to, if there's anything else folks here today should be thinking about as they approach M&A or capital markets for the year, and final thoughts from our panelists.
I'll just conclude by saying I think you all are in a very important industry, and I think execution, data, trials, that's all that matters. I think everything else will follow. So if you have the right technology and you do the right execution with appropriate patient population, and you help people with their quality of life and cure diseases, I think capital markets will be open regardless of times, M&A will be available regardless of times. So I think our industry is really more fortunate in that regard. And I think value creation is unprecedented versus any other industry. So I think we're very fortunate to be part of this industry. So I would just say keep up the good work.
Yeah, I would just say thank you. You have the hardest job in the world. You're actually trying to help people. Everything's stacked against you. You're making, raising capital, executing trials. So without you all, we wouldn't even have jobs up here today. So it's really up to you to keep the industry driving, and everything should be done on a going concern basis, because there's 20 deals a year over $100 million, and of those 3 deals make up 80% of the value on the M&A side. So you can't build a company. So you have to build a company to impact human health and have a big long-term going concern. So that would be my say.
So I would say that most companies, I think, who are attending here are not well financed by major venture capital firms, and just continue to be scrappy. There's a lot of great investors who are often who are showing up at this Ashburn conference and other similar types of events. So continue to look for capital wherever it lies, and I think you'll live to fight another day and hopefully add a lot of value.
I'd say my final bit of advice would be being able to prioritize is very difficult for companies with great technology. Have a lot of options to use it, and I would say my advice would be focus and invest in a program in an optimal way versus trying to invest in multiple programs but only have enough capital to do it suboptimally.
And I would say that if you're looking for an investor or strategic partner out of China, make sure that you have a trusted U.S. Partner bringing you there. Learn WeChat, that's how it gets done. Also, be really careful not who you do your first deal with and what happens to your China rights, because once you've given away your China rights, you might not attract any more capital or any more interest out of China. It's a very competitive market, and so that's really important. I see that all the time in these partnering systems. People reach out to me, seeing that I'm with China. It's actually a global VC, and we've out-licensed our China rights, or we have a China partner. It's like, delete. I mean, like, it's done. So you need to be really careful about that. But I've had a great experience doing business in the region, and you find the right partners, and it's kind of fascinating what's going on there.
Well, thank you very much, everybody.